All right, let's get right to it. A huge financial reset is coming, and it has a very specific number attached to it. $6.4 trillion. That is the specific amount of liquidity, all the cash sloshing around the financial system that is about to straight up vanish from the markets. Now, look, this isn't some wild guess or a vague prediction. It's a calculated reset by the Federal Reserve, and yeah, it has a hard deadline. Just look at this timeline right here. See? We're kind of in this business-as-usual phase until the end of 2025. But then, bam, January 1st, 2026. That's when we hit what everyone's calling the reset. And no, this isn't some far-off sci-fi future. We're talking right around the corner. So if you thought the last couple of years were a wild ride, you really need to see what's coming next. Because trust me, this isn't just about Wall Street traders in suits. By the time we're done here, you're going to understand exactly how this multi-trillion-dollar move is going to hit your daily life. I'm talking about your rent, your savings, and yeah, your portfolio. Okay, so how is this even happening, right? Where is all this money actually going? Well, it all starts with the Fed's giant and rapidly emptying piggy bank.
So the key here is a wonky-sounding thing called the reverse repo facility. And I know. The jargon can make your eyes glaze over. But don't worry. Just think of it like the government putting money in timeout. It's basically a tool the Fed uses to suck cash out of the banks for a little while, to keep it out of the system, help control inflation, and kind of put a lid on interest rates.
And this is where it gets really interesting. Just look at the speed of this drain on the chart. That reverse repo balance, it's already down by a staggering $840 billion. You can see the peak balance right here in this tall green bar, and then look at this much smaller red one. That's where we are now. That cash is being yanked out of the system at a frankly incredible rate.
Now, I know exactly what you're thinking. Just print more money, right? I mean, the Fed did it for years. Well, guess what? The bills come due. And it's really not that simple this time around. Which brings us to the most important part. Really. The connection between all this Fed spreadsheet nonsense and your actual bank account. Why does it feel like your wallet is in a permanent vice grip? Let's just break this down into two simple realities. Over here, you've got the Fed's world. They're issuing an insane $132 billion in new debt every single month. Then over here, you have our reality, just trying to afford a house on, say, a $60,000 salary. These two things are completely out of whack. The government is pumping out debt way faster than we can absorb it, and that right there is a huge reason why buying a house feels pretty much impossible. And this number? This is what's keeping all the pressure on. 5.25%. That's the super sticky baseline interest rate that's making everything, mortgages, car loans, you name it, so brutally expensive. The Fed says they're keeping rates this high to fight inflation, but for the average person, it's just a massive headwind. So here's the really unsettling part. We have to talk about something called the lag effect. It's simple, really. It just means the full impact of these rate hikes hasn't even hit us yet. It takes time to ripple through the whole economy. So all that financial pain we're feeling right now, it could just be the appetizer. The real squeeze on your mortgage, on your student loans, that might not fully hit until 2026. Okay, so that's the problem. It's big, it's complicated, and it's coming straight for us. So the real question is, what can you actually do about it? Let's get into your personal financial playbook for 2026. This is the actionable stuff. All right, here it is. A clear three-step plan to get yourself ready. Step 1, audit your savings. Right now, in this high-rate world, if your high-yield savings account isn't paying you over 4%, you are literally losing money to inflation every single day. Move it. Step 2, build up your cash cushion. I'm talking about increasing your emergency fund by at least 15%. Because when cash gets tight for everyone else, having your own is a superpower. And step 3, attack your variable rate debt. I'm looking at you credit cards, and I'm about to show you exactly why this is so important. This is why that last step is non-negotiable. The projected average credit card APR is on its way to a jaw-dropping 24.99%. Let me say that again, almost 25%. Carrying any kind of balance is about to get exponentially more painful. So, let's just boil it all down. The bottom line is this. The Fed is officially pulling the plug on the era of easy money. And in a world where cash is about to become scarce, having your own makes you king. Cash is absolutely king for the first quarter of 2026.
Look, this whole situation is going to keep evolving, and being prepared is your only real defense. So don't let the Fed surprise you in 2026. Subscribe for the next update so you can stay ahead of the curve.
Just a quick reminder, this content is for educational purposes only, and past performance doesn't guarantee future results.